Let's talk about notes receivable. If we're a bank, we're lending money all the time, but even if we're not a bank, sometimes we'll lend money to our suppliers, to our customers, or to our employees. We'll need to know how to calculate interest, how to accrue for interest receivable, and how to accept payment of principal and interest. The difference between an account receivable and a note receivable is that a note receivable is in writing and it bears interest. All right, so let's pretend like we lent $1,000 to Mr. Holland on August 31st, and it's going to be due, principal and interest are going to be payable on February 28th of the next year. So we debit note receivable Holland for $1,000 because any account that has the word receivable in it is an asset account, and assets increase with debits. We credit cash because we're lending money. Cash is going down. Cash is an asset. It increases with debits and decreases with credits. Let's say it's December 31st. We haven't made any adjusting journal entries yet, but we're getting ready to close our books, so we have to accrue for the interest that we've earned. On August 31st, Mr. Holland owes us no interest. If he'd repaid us on that very same day, we wouldn't have collected any interest. But after 1 day, he owes us 1 day worth of interest. After 2 days, he owes us 2 days worth of interest. After 3 days, he owes us 3 days worth of interest, etc. So as of December 31st, he owes us interest for September, October, November, and December. He's not going to pay us any cash until the end of February, but we need to get that interest revenue that we've earned into this year. Well, the principal amount on the note is $1,000. So 1,000 times 0.09 equals $90 would be 1 year's worth of interest. But he hasn't had our money for a year yet. He's only had it for 4 months. So let's divide that by 12. And that tells us that the interest is $7.50 a month. We need to accrue for 4 months worth of interest, so we'll multiply that number times 4, and we'll discover that he owes us $30 worth of interest. We'll debit the account interest receivable. Any account that has the word receivable in it is an asset. Assets increase with debits. And we'll credit interest revenue for $30. If expenses are debits, expenses are debits, expenses are debits, the opposite of expenses is revenue. It must increase with credits. Let's skip forward in time to February 28th. It's time to pay us off. Certainly he owes us $1,000 worth of principal. He also owes us that $30 of interest receivable that we booked previously, but now he owes us 2 more months of interest. He owes us for January and February of, let's say, 2015. How much is 2 months worth of interest? $1,000 is the principal times 0.09. Again, that would give us a year's worth of interest. Let's divide that by 12, and that tells us how much 1 month worth of interest is. Let's take that and multiply that times 2, and we know that 2 months worth of interest is 15. So that means he's cutting us a check for $1,045. $1,000 for the principal, $30 to pay us off from the interest receivable we booked for last year, and 2 months worth of interest revenue for this year. So in this journal entry on February 28th, this $30 entry here represents the interest we earned during 2014, and this $15 represents the interest that we earned during 2015. Since we're doing accrual accounting, we want to get our interest revenue into the correct periods.